Hi everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in corporate filings. And today we're diving into Value Line Select Growth Fund Inc.'s latest report. Get ready for some juicy financial performance details. It's all about the money. So what's the big story here? It looks like Value Line's Growth Fund is reporting some interesting numbers for the first half of 2025. Let's see if they're growing as fast as they claim and what that means for investors. And hey, if you appreciate getting straight insights from corporate documents, make sure you're subscribed and join our Discord community linked in the description below. We break down these filings. This filing is all about how the Value Line Select Growth Fund Inc. performed. It's like a report card for the fund's money-making abilities from January to June 2025. They have different types of shares, like the institutional class and the investor class. The institutional class is usually for big money players, and the investor class is for regular folks. Let's talk about costs. It's important to know how much you're paying to have your money managed. For the institutional class, investing $10,000 would have cost you about 46 months. That's a small percentage, less than 1% of your investment. Now, for the performance, the really exciting part. The institutional class of this fund grew by 12% in just 6 months. That's pretty good, especially since they said they beat the S&P 500 index. That means their picks did better than the average big company in the market. They bragged that their good stock picking was the main reason they beat the S&P 500. This is key for a growth fund. This is what they should be doing. They did particularly well in the industrial sector, which is a big positive. This means they invested smartly in companies that make and sell industrial goods and services, and they picked the right companies within that sector too. But it wasn't all smooth sailing. They lost some ground in the information technology sector. This is common though, as tech can be a volatile area. Looking at individual companies, Cintas and Transdim Group were big winners for them. Cintas makes uniforms and business services, and Transdim makes aerospace parts. Both saw double-digit gains because they did better than expected financially. Interestingly, they actually did better by not owning Apple stock. Apple's price dropped, and by avoiding that fall, the fund looked better compared to the market. On the flip side, they lost money on Accenture, which provides IT services, and Thermo Fisher Scientific, which is in the life sciences business. Both had double-digit drops in their stock prices because they didn't perform as well as the investors hoped. And another big miss was not owning Nvidia. This company makes computer chips, and its stock price shot up. By not holding Nvidia, the fund's overall performance suffered. Let's look at this table showing how $10,000 invested would have grown over time. You can see the fund's value and the S&P 500's value month by month. It's a great way to visualize their performance. This section compares the institutional class directly against the S&P 500. You can see how $10,000 would have changed starting back in May 2020. Now let's check out the average annual total returns. For the last year, the institutional class returned 11.80%, while the S&P 500 was a bit higher at 15-16%. Over 5 years, S&P 500 was a bit higher at 15-16%. Over 5 years, though, the fund really shines, gaining 13.73% annually compared to the S&P 500 16.64%. And since inception back in May 2020, the fund has a solid 15.64%. And since inception back in May 2020, the fund has a solid 15.07% annual return. Here are some key statistics about the fund. The total net assets are a whopping $433 million. That's a lot of money they are managing. They hold 27 different investments in their portfolio, and their portfolio turnover rate suggests they buy and hold investments for longer periods, which can be a sign of confidence in their long-term picks. Now, let's look at where all that money is actually invested. Here are their 10 biggest holdings. Transdim Group is a major investment at 7.2%. Then comes Cintas at 6.4% and Costco Wholesale at 6%. These top holdings show where the fund managers see the most potential. Looking at how their money is spread out, 97% is in common stocks, which makes sense for a growth fund. The rest, 2.3%, is in cash and other assets, which is normal for operations and liquidity. And here's how they've divided their investments across different industries. Information technology is their biggest bet at 31%. Industrials are next at 25.9%, followed by financials at 20.4%. They seem to be focusing on areas with strong growth potential. Now let's quickly look at the investor class. It generated a total return of 6.99%, slightly less than the institutional class, which is expected given different fee structures. The costs for the investor class were a bit higher, costing $59 for a $10,000 investment or $15 investment, or 1.115%. This difference in cost between the two classes is pretty standard. The performance analysis for the investor class mirrors the institutional class's commentary, pointing out similar strengths in industrials and weaknesses in information technology, as well as the impact of specific stock selections like Cintas and Transding, and the decision to avoid Apple and Nvidia. Looking at the average annual total returns for the investor class, it's slightly lower than the institutional class across the board. For 1 year, it's 11.54%, 5 years, it's 13.44%, and 10 years, it's 12.98%. The S&P 500 generally outperforms it in these longer time frames, but the fund still shows respectable growth. The key fund statistics like total net assets and portfolio holdings are the same for both classes as they manage the same pool of investments. And the 10 largest holdings are identical, showing a consistent investment strategy across both share classes. This part of the report talks about the Audit Committee financial expert. They've designated James Hillman as this expert. Essentially, this means they have someone on the team with specific financial knowledge to oversee the audit process, which is good for transparency and accuracy. Then we get into the detailed financial statements. We've already touched on some of the highlights, but this is where you'd find the nitty-gritty numbers. This is the most detailed section, the schedule of investments. It lists every single company the fund owns. For the Value Line Select Growth Fund Inc., their top holding is Transding Group, Inc. at 72% of their net assets. They also have substantial holdings in Cintas Corp. at 6%, Allforp at 6%. Their asset allocation is also detailed here, showing 97.7% in common stocks and 2.3% in cash and other assets. And the sector weightings show a significant focus on information technology at 31%, industrials at 25.9%, and financials at 20.4%. This confirms where they're placing their biggest bets, looking at the broader financial picture. Value Line Select Growth Fund Inc. seems to be navigating the market reasonably well. They're boasting performance that beats the S&P 500, primarily through smart stock picks, especially in sectors like industrials. However, the tech sector proved to be a challenge, with some individual stock selections, like Accenture and Thermo Fisher Scientific, dragging down returns while missing out on Nvidia's surge was a notable setback. The fact that they avoided a significant drop by not holding Apple is a small win in itself, showing some decisiveness in their strategy. Their two share classes, institutional and investor, reflect typical industry practices with slightly different cost structures and performance percentages. But the underlying investment strategy remains consistent. The fund's substantial net assets indicate investor confidence, and the low portfolio turnover rate suggests a buy and hold strategy which aligns with a growth-focused objective. A key takeaway is their sector focus, heavy on tech, industrials, and financials. This is a common playbook for growth funds, but it also means they're exposed to the risks inherent in those sectors. The presence of an audit committee financial expert adds a layer of financial oversight, which is always a positive sign. Overall, the fund appears to be managed with a clear strategy, acknowledging both successes and areas for improvement. While they're aiming for growth, investors should note the risk associated with their sector concentration and the impact of individual stock performance, especially in volatile areas like technology. The comparison to the S&P 500 shows they can be competitive, but the reliance on stock selection means performance can fluctuate. Alright, that's our breakdown of Value Line Select Growth Fund's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.